The stock market is holding its breath as futures show little movement, with investors anxiously awaiting the Federal Reserve's highly anticipated decision on interest rates and the crucial guidance that will accompany it. This moment is charged with anticipation because the Fed's announcement could steer the U.S. economy in a significant way. On Tuesday evening, futures tied to the S&P 500 edged up by a mere 0.02%, while Nasdaq 100 futures saw a similarly small advance, also around 0.02%. Dow Jones Industrial Average futures rose slightly by 13 points, representing a 0.03% increase. These subtle shifts suggest traders are cautious, keeping their positions steady as they prepare for the Fed's update. Almost all market participants expect the Federal Reserve to lower interest rates this Wednesday. This expected move aims to provide a boost to the U.S. economy amid signals that the labor market is weakening, even though inflation remains stubbornly above the Fed's long-term goal of 2%. In addition to announcing any rate changes, the Fed will release its dot plot, a chart revealing individual policymakers' projections for interest rates over the upcoming year. This dot plot is closely watched because it offers insight into the central bank's future monetary policy direction. But here's where it gets controversial. Investors are also tuning in to see if any Fed members dissent from the consensus. At the last meeting in July, there were two such disagreements, highlighting that even within the Fed, opinions on the appropriate course of action aren't unanimous. Traders currently price in a 96% chance that the Fed will cut rates by 25 basis points, a quarter of a percentage point, and only a 4% likelihood of a larger half-point cut. These probabilities are derived from futures trading data at the CME Group. Paul McCulley, a former managing director at PIMCO, weighed in during a Tuesday segment on CNBC's The Exchange. He suggested the most probable outcome is a cautious 0.25% rate cut. McCulley reasoned, "Frankly, I can't imagine how the Fed would justify a more aggressive 50 basis point cut unless the labor market was signaling severe distress, which I don't believe Chair Powell wants to convey at this moment." Meanwhile, stocks largely ended Tuesday's trading session without major changes. The S&P 500 briefly hit a new intraday record before retreating. The Dow Jones Industrial Average closed 0.27% lower, shedding approximately 125 points, while the tech-heavy Nasdaq Composite missed out on extending its recent record-breaking run. Adding to the day's market moves, shares of Cytokinetics rose about 1% in after-hours trading, following the company's announcement that it plans to raise up to $550 million through a convertible senior notes offering maturing in 2031. On the topic of Fed policy impact, Subadra Rajappa, head of U.S. rates at Societe Generale, warned on CNBC's Fast Money that stocks could face a downturn if the Fed adopts a less dovish stance than what the market currently anticipates. Rajappa explained, "We might see an unwinding of recent market gains if investors perceive that the Fed isn't ready to be as aggressive in cutting rates as expected." This underscores how sensitive markets are to the Fed's messaging, especially with the dot plot release looming, which could reveal a more cautious or aggressive stance on future rate cuts. In summary, as stock futures remain almost flat, the financial world is on edge. Investors and analysts alike are combing through every hint from the Federal Reserve to gauge what's next for interest rates, inflation, and economic growth. And this is the part most people miss. While the market seems calm right now, any unexpected tone or deviation in the Fed's outlook could ignite turbulence. What do you think? Is the market correctly pricing in a mild rate cut, or might the Fed surprise us with a bolder move? And if the Fed signals caution, how should investors prepare for potential volatility ahead? Share your thoughts in the comments below. Let's debate the future of monetary policy together.